Hi traders, this is Cynthia of Day Trade Forex bringing you a training video for the Simple Neon Breakout to show you how I trade the retracements and how I use a special money management technique for managing your lot sizes so that you don't over leverage your account. First of all, in a daily chart, we're looking at the Euro US dollar, and you can see this Donchian channel is very narrow, and you always want to first measure your Donchian channel to see what your range is, and this is a 266 pip range when it's at the narrowest. So that's even tradable as a day trade, scalp trade, or swing trade. It doesn't matter. It just depends on what time frame you want to trade in. I just want to very briefly show you the rules for your retracement trading, and then I'll talk about how to manage the lot sizes. Starting at the beginning of this chart, it's really easy to see in hindsight what you could have done, and I'm going to use the vertical lines to show you my sell entries or buy entries. So first of all, click right there and just start placing. This is a practice. You can do this yourself going back in a demo account. Just put up a daily time frame or even a 4-hour time frame and just practice picking out your entry and exit points, and you start with the main window. That's your first place to look. So the red vertical line, let's just go place according to the main chart where we think our sell entries would have been. This is just practice. This is what you need to do to be able to learn how to recognize your entry and exit points, because learning how to trade retracements is based on this. This is a buy right here. Change your vertical line properties to green. Okay, so now you have all of your entries and exits marked clearly. Once you've added your vertical lines, then let your eye run down to the volatility window to make sure that you've picked out the perfect entry. So in this one, this is perfect. The red bar is below the red zero line. That's important, and it's very strong. And same with this one. The green buy is a strong volatility bar above the red zero line. This is a perfect sell entry, and this is a perfect sell entry. Now we want to look at what could possibly be a retracement. Starting at the beginning of this chart, you have the green candle, which is a retracement. And if you let your eye drop down to the volatility window, you also have a green volatility bar, and the yellow signal line for volatility or momentum is withdrawing back towards the red zero line. This is showing you that momentum is slowing down, and it's reflected in the green bar and the green candle. So that day was actually a retracement day. The next day you had another red candle, and the volatility bar turned red again. Now that would have been your first sell re-entry, and of course remember that the long slow trend slope, you never trade against it. So as long as it's red and everything confirms in the main window and bottom window, then you can take another sell entry. So this would have been our first sell re-entry. Then the next day was another pullback day. The candle turned green and the volatility bar is green, and it's really shrunk back closer to the zero line. So momentum is really slowed down on this day. You don't take any action, close in any of your trades at this point, because the volatility bars are still below the red zero line. The next day is another pullback day, and then the next day is a longer candle, and it's red again. And look at the volatility bar, it's much longer this time. That means the push to the downside was much stronger. And the next day just was another down day, but then this day you have a green candle and the bottom was found on the Donjian channel, and your medium trend line has turned aqua partially through the candle. But the important thing is down in the volatility window, the yellow signal line has crossed up above the red zero line. So that's your signal to exit all of your trades. First, we're learning how to place the retracements, and then after we finish this, I'll make another video or add on to this video to show you how to manage your lot sizes. At this point, you're out of all of your trades completely. You actually do have an uptrend here, which I totally missed. So let's place the uptrend. There's a green arrow, a green dot. Your trend lines are all green, and your volatility bars are green and above the red zero line. So let's change this to so at this point, getting in right here, you can see the little doji candle right here, where that means price is in conflict. The buyers and the sellers are equal in force. That's still a 200 pip trade right there. The point to decide to get out when you see this doji candle, you want to actually get out maybe before the next candle turns pink, or when you see it start to turn pink. The confirmation to get out would be when the yellow signal line starts to slope down and the volatility bar turns pink. At that point, you could get out. Even if you got out halfway of this candle, that's 125 pips. In a daily chart, you can see the long moves, but you're also going to have, at least 80% of the time, you're going to have this narrow range. So when it's in a narrow range, you have to be prepared to take an early exit. Now, this actually was another sell entry here. Everything was actually pink and the volatility bar dropped down, so I missed that sell entry. Sorry. I was going for the more obvious. Change that to red. But even these little moves can get you 50, 100 pips or something like that. This one was pretty short-lived. It was just that one day. Even that one day candle, the open was 1.2309, the high was 1.233. So that would have been a failed trade completely. So sometimes when you're in a narrow range like this, there's really not a lot that can protect you from a short trade. So this would have been a failed trade, and that does happen from time to time. Now, these next candles, they're green, and the volatility bars and the signal line are above the zero line. However, you're kept out of a long trade because of the magenta dots. You've got three trend lines in the main window: a super fast magenta dot, and a medium trend line, and a long slow trend line. One or the other will protect you from getting into a bad trade much of the time, but like we saw in this candle, it didn't really help. That does happen from time to time, but not very often, as you can see. Now, this next sell entry was a perfect sell entry, and here would have been a complete exit because the yellow signal line and the volatility bar are above the red signal line, and the volatility bars turn green. So let's see how many pips that would have been potentially. Well, that's 80 pips. So you're still in a very small range here. So that's why you have to measure your range before you ever get into a trade, because you don't want to have high expectations of a big move when the range is very small. We are waiting for a breakout. This is a breakout system, but in the meantime, you can trade these narrow ranges. However, you have to know the width of the range, and the only way you can do that is with your crosshairs. So at this point, this range is 261 pips. That doesn't mean you're always going to be able to carve out that many pips. You're waiting for a breakout. Now here's another buy entry that we totally missed the first time. but it was just a 1 day bullish candle, and the next day the price did hit the top of the Donchian resistance channel, and so it meant that you entered this trade sort of in the middle of the channel, and it didn't really have that far to go. So if you carved out 100 pips or something like that on that 1 day trade, that would have been doing pretty good. When the price hit the top of the Donchian channel, that was 160 pips. But realistically, if you had gotten out, say at 100 pips, when you see the little Donchian arrow appear telling you you've hit resistance and the candle turns pink, and down in the volatility window you see the yellow signal line slope down and the volatility bar turns pink, get out as quickly as you can, because this is all telling you that the range is very small, and if you've netted 100 pips, you've done really, really well. Now the next day the candle turns red again, and it's a nice sell entry, and you can stay in this sell trade as long as all of the volatility bars stay below the red zero line. This is the day when the volatility bar and the yellow signal line crossed above the red zero line. So if you look at this day, it's a day where everything is still pink, but the candle turned green, and halfway through the day the medium signal line turned green. So at some point cross the zero line. So that's your clue to get out. Immediately get out, because that way you're not sacrificing too many pips just staying in the trade for no good reason. So say you got in halfway on this candle and you got out on this candle somewhere, that's 140 pips. So you should have been able to get that, or at least 125. That's okay. This is your next, well, you had a few re-entries here, but because the Donchian channel is so narrow, this is like the narrowest it's been looking at this whole chart. So I'm a little hesitant to place a lot of re-entries when it's a very narrow range. You can try it. Say that you decided to re-enter on this. This day was right after a pullback day, and let's see if you had gotten in there and exited here when you exited your initial trade. That's still 90 pips, maybe at the most 100 pips, maybe 55 pips. It's hard to say. So you can still, if a narrow range, at least have a target goal of maybe 50 pips, 50 to 100 pips, and that's being conservative but realistic. On this day, it looks like the Donchian channel is expanding a little bit, and if we had entered here when the arrow turned green, everything turned green, and the volatility bar was green and above the red zero line, you would have gotten out. Well, let's see. You would have had a down day here, and this day here, the candle just didn't do anything, and you can see down here in the volatility window, the volatility just shrunk back to nothing. But you would have stayed in the trade because the yellow signal line did not actually cross the red zero line. So if you had stayed in this trade and considered exiting when you see the Donchian channel arrow appear, which means you hit resistance again, even though everything is still blue, at some point here the medium trend slope turned pink. At this point your yellow signal line did cross the red zero line. So possibly, depending on where you got in and exactly where you got out, if you got out when the Donchian channel resistance arrow appeared, that's 60 pips. So again, that's not a very long trade, and now we're seeing the expansion of the Donchian channel. So this is your sell entry. Then you have the 2 days later retracement, so you would have had another sell entry. You can be a little more confident about your re-entries when the Donchian channel expands, because that means that volatility is picking up, and what you're looking for is a breakout based on volatility. So this would have been your second sell entry, and then the next day everything goes down still, and then the next day the candle turns green, volatility turns green, And then, but look at how the red line and the magenta dot line, they're separated now a little bit further away from the candle, so that shows you that momentum has picked up. When you see the candles and all three trend lines squished together like this, there's no volatility, there's no momentum. So now volatility is picking up, momentum is picking up, because you can see the space. There's more space now between the long trend line, the dots, and the candle itself. So that's a good thing to see. That means momentum is picking up on this downtrend. Then this day you have a little bit of a pullback, and then the next day the trend resumes again to the downside. So you can keep placing trades as long as the volatility channel is wide, there's space between the trend lines, and as long as these bars stay very long below the red zero line, you know you have sufficient momentum. But on this day, you can see how the yellow signal line and the volatility bars have shrunk back to the zero line. So this is the corresponding green candle. That's an excellent place for you to take your profit. You can take partial profit from these three trades. That means exit half of each trade at this point. Now that's a very basic money management technique, but that's not the special money management technique I'm going to teach you. However, this is basic, the most simple form of money management for using reentries. What I mean is that each one of these trades could have been the same lot size, and then here you would just close out half of the lot size for each trade. That's the most basic way to handle your money management and your lot size management when trading retracements, but that's not the secret sauce that I'm going to teach you. After this little pullback, you have another sell reentry. So now all of these trades, for the basic money management technique, you've taken half of the lot size and booked half the lot size as profit. So now you've reduced your margin usage. It's a little bit safer for you now. You're not using as much margin, so your risk is reduced, and you've bagged half of these trades as profit. So now you've gained some profit, and this is your re-entry again, and the trend keeps going down for 3 days, but you can see this candle is very small, and the volatility bar is green, and the yellow line is pulling back to the zero line. At this point, you exit that trade completely. In fact, at this point, you would exit all trades. You would be in 4 trades. This would be your full lot size, your full normal lot size. Each of these trades would be half of your lot size. So at this point, you would exit all of the trades at the same time and be completely out of the trade. Now, this looks like it's a little uptrend, but it's not, because the red trend line is still going down, and even though you have a little bit of green here and the volatility bars are green, the candles are still underneath the red slope, and even though it pokes up a little bit here, that is on a day when the volatility bar has turned red again. So definitely you have to learn how to read these signals, these signs. Now this is another sell entry. Remember, at this point you're not in any trade at all. You've closed all of your trades at this point. Now you're in another sell entry, but the volatility is not so strong. Look at how short the volatility bars are. And none of these days would be considered a retracement until the day when the candle turns green. And the volatility bars are now above the zero line. So at this point, I would exit. When you see this yellow signal line cross the red zero line, just exit your entire trade. Don't stay in the trade. However, here you have another sell entry, and then the next day is a pullback, but it pulls back and to the red signal line, and the bar is very short, so the volatility is really drying up. Momentum has slowed down so much, and so I would exit this trade completely at this point. But then the next day you have another sell entry. volatility bar is getting a little bit longer, and you have 2 full days after that of a really strong push to the downside, but then it pushes down so far that it hits the Donchian support. The little Donchian arrow appears to tell you that you've hit support, that also volatility has shriveled up to nothing, because you see the yellow signal line sloped up and crossing the red line. That tells you to get out of your trade completely, and then everything reverses. Even though a lot of this is still pink, you've got still some green here, but that's mixed colors. That's a consolidation area, and we just don't consider trading until we get a new confirmation where everything turns green, and that would be right here. That's your buy entry. Now let's see what happens after that. Price goes up for maybe 1 or 2 days, but then you can see that the volatility bar turns pink and the yellow signal line starts sloping down. At that point, I would be suspect, since we've had such a long run down for so many days, that this is probably just a pullback, and we can't expect a lot out of a pullback. So it's time to remeasure your Donchian channel again. It's 493 pips. So right now price is kind of right in the middle of the Donchian channel. It didn't go up to the resistance. It kind of pooped out right about here when the volatility bar turns pink. That's 130 pips. So if you had been able to squeeze 100 pips out of that, you're doing pretty good. Look at all the mixed colors. The candles are mixed color, but the clue to momentum slowing down is this yellow signal line crossing all the way back down to kiss the red zero line, and the red momentum bars have started shrinking back again. Now at this point, I want to mention for probably the first time that what we're seeing now is called divergence. Part of this trading course is teaching you how to recognize divergence. Divergence is a leading indicator of price action. So even though you see in these number of days here where price pretty much is flat, the candles are really small, this volatility window is giving you a clue of what to expect coming in the very near future, especially after the yellow signal line actually touches the red zero line. That's telling you that momentum has dropped to zero. There's no momentum at all, and the price is very flat. It's not going anywhere. It's not going up or going down. But this is telling you that the future price action will be to the downside, because divergence is a leading indicator. This is showing you what they call bearish divergence, which is a forecast of a price reversal in the very near future. So you had one short little blip up, and then pow, we had a news event, which means that you really have to pay attention to your Forex Factory calendar, and you would have known that this news event was happening today. And of course you would not even be in a trade at this point, because you would have gotten out of your trade right around here when you see the volatility drop off so sharply. So you would have been out of this trade and just sitting and waiting, and then you would have known that a news event was coming, and this would have been the day that you would have sold, and this was a perfect sell entry. That's the basic fundamental of trading retracements, and a very quick introduction to divergence, which I'll go into more in future videos for training. But now I want to show you the special secret sauce of the money management, lot size management, because this was the simple example of entering each of these trades with your normal lot size, that of course you're being very careful and you're not using lot sizes too big for your account. You're smart about that, because especially if you're going to be trading retracements, you have to start with smaller lot sizes than you normally would think you would trade with anyway, because if you're going to be placing multiple entries, you have to be more careful with your lot sizes and your margin usage. Again, the very simple way of entering each retracement trade is to use the same lot size. And at this point we took partial profit off of each trade, and then at this point we took full profit. We closed all of the trades. That's the very simple basic way of trading retracements. Now I'm going to teach you a safer way to trade your retracements. It's more complicated, but it's safer. It uses less margin. Let's use this sell trade as an example. Say that your account is $1,000 and you're used to trading with 0.06 micro lot size. In order to use this money management technique, you really do need to have a micro account with your broker that allows small lot sizes like 0.01, 0.02, 0.03. If it only allows a lot size of 0.1, which is a mini lot, then this won't work for you. You really need to have a micro account so that you can trade 0.01, 0.02, 0.03, etc. So say that you normally trade 0.0, let's round it off to make the lot sizing a little easier. Say in $1,000 account you would trade this with 0.06. That's okay for your initial trade. Now I'm going to show you the secret sauce for the complicated lot size trade management, which actually will gain you more money with the same number of pips and this trend. It'll gain you 3 to 4 times more money than just using the simple lot size management. So say your account is $1,000 and you're used to trading with 0.06. Your first initial trade is placed and you have no other open trades. So in order to place a trade with 0.06, you can't have any other open trades. So this would be a trade placed for 0.06. On this pullback day, when the candle turned green and the volatility bar turned green, you exit half of your lot size. So you book 0.03 and you're still open with 0.03. Then on this candle, it's another down day, so you can place another sell trade for 0.03. Now you have 2 trades open for a total of 0.06. And on this day, what you would do is, this is another retracement day. What you can do is close out 0.01 from the first trade and 0.01 from the second trade. And so then on the next day, when you do another re-entry, you can re-enter with 0.03. So now you have a total of 0.07 open still. And so you've booked some profit along the way, and your trade size is just a little bit larger than it was originally. But look at where you are in terms of the number of pips to the downside. You're at this point 350 pips down, and you've booked profit along the way. At this point, just close out half of all of your trades that are still open. So now if you had 0.07 open, close half of those. So I would close 0.04 and I would have just 0.03 open at this point. And then when the trend resumes on this candle and you re-enter with another sell trade, re-enter with 0.03. So now you have 0.06 still open, but you've booked a lot of gain already. This is the point where you would close all of your trades. So 0.06 is open, you close all of them. So I would have to add up the number of pips. I'm trying to do this while talking and not writing it on a piece of paper, but you can go back and rewind this video and add up the micro lots that you've already booked as gain and figure it out. I can't do it while I'm talking in a video. It's impossible for me to do that. That is, in a nutshell, how you would do the secret sauce lot size management. It's definitely more complicated, but in reality it books more gain while keeping your lot sizes at a manageable, realistic amount, so that you're not over leveraged at any time at all. You're not using much more leverage than you would have been if you had just traded 0.06 and stayed in this trade and never taken a profit. Of course, you can do that if you don't want to do this lot size money management. So you can just stay in the trade and just ride it all the way to the bottom and exit here. That would have been, let's see, from here to this total exit place right here is 538 pips. You can just do that as one long trade without any sell re-entries, without any fancy lot size management. Or you could just do the simple lot size management where you just enter 0.06 here, and each new trade just enter 0.03, 0.03, 0.03. Here you would have had to book some profit. So it depends on if you want to keep it super simple or a little bit medium complicated or super complicated. And it's your choice depending on how mathematical your mind is and how well you can keep track of all of this, because you do need to keep track of this at least on a piece of paper, each re-entry, what your lot size is and what you book, so that you always know how much margin you're using each step of the way. That's very important that you keep track of that. Basically, this is your first approach to lot size management for trading retracements. You can keep it really simple with just one trade down to the bottom where you exit that one trade here, or you could do the multiple sell re-entries and just use smaller lot sizes along the way. You don't even have to book any gain if you don't want to, but I think it's smart always to. Or you can use the complicated lot size management, which actually nets you the most and is actually the safest. So if you're a good mathematical mind, and you can go back and watch this video again and again and keep track of your lot sizes as you open each trade and as you book some profit. Once you get the hang of it, it's not really that complicated, but I would start with just the basic thing. Just start with the very basic, which is finding the trade entry and writing it to the bottom until you exit. Then practice with multiple re-entries, and you can just use smaller lot sizes, just 0.03, 0.03, 0.03, exit half of all your trades, 0.03 resell entry, exit that completely. That's the very simple way of doing your re-entries using the simple lot size management. And then the complicated lot size management, you'll just have to re-watch the video. So thanks very much for watching this long video, and I hope that this gives you an idea of a way to manage your trades in a different way, which actually books a lot more gain and a lot more profit and is safer for your account. And don't be afraid to take partial profits at any point, but if you see that the trend is really strong to the downside, and this red line here is far away from the candle, you know the momentum is strong. If the Donchian channel has expanded, you know the volatility and momentum is strong. Don't take full exits until the yellow signal line actually crosses the red zero line, because you'll be giving up too many pips. Just take partial profits along the way and then re-enter. So this is maybe a new way for you to learn how to trade. It's not easy, but you'll be netting a lot more pips in the long run, which means a lot more dollars, and you'll be doing it in a safer way. So thanks again for watching, and I'll see you in the next trading video, which I'm going to talk more about divergence as we see it right in this area here. This is a perfect example of divergence, and I'm going to show more of divergence to you in the next video.